Hello, everyone, and welcome to episode number 86 of Just Dario Cigar Time. Today is Sunday, the 18th of July. I will again try to do my best today to provide you with an update on all the mess and important events that happened this week in markets. It was a week where I did not have time to record our usual midweek update. Things were evolving too fast. And to be fair, I didn't even have the energy to do so because throughout the whole week, I slept very little to keep a close eye on the crude oil market. Unfortunately, the crude oil market trades 23 hours a day, Sunday 6 p.m. Eastern Time to Friday 4 p.m. Eastern Time. If you remember last week, I began my video by saying that we were entering option expiration week for NYMEX crude oil option, as well as for stocks, indexes, and ETFs options. I said that traders and market makers would have fought hard to defend their positions. They would not want to be overwhelmed by the course of events. Then there was another thing I said, but actually that was a joke. I said it was paradoxical that to bring those very few ships to the Strait of Hormuz, the US military needed so much escort. And according to some estimates, they were spending almost $1 million per hour. With regards to option expiration, I'm going to have a lot to talk about in a minute. But with regard to that joke I made, reality caught up with me incredibly fast. On Monday, President Donald Trump announced that the US would start being the guardian of the Strait of Hormuz. He said they will charge a 20% rate on the value of the cargo for all ships crossing the strait under US protection. Someone might have either told him my joke, or they might have told him how expensive the endeavor was for the US military. And they needed some revenues to support it because $1 trillion a year is not enough to cover all US military expenses anymore. The market took that news quite badly, and that was not a surprise and fairly understandable. I bet that after Trump made the announcement, all his allies started to bombard him with phone calls. They requested he scrap and walk back the 20% tariffs on the Strait of Hormuz because it was nonsense. The following day, on Tuesday, it was the perfect day for a taco, and President Trump delivered it. Also, to make sure to cool down the heat in the crude market, where the temperature was rising dangerously fast towards the level where it would have triggered an explosion, instead of charging on the value of the cargo to compensate for the cost of managing the strait and military protection, Trump claimed Middle Eastern countries, part of the GCC, had agreed with him to invest an undefined amount of billions of dollars into the United States. Of course, something that he has been claimed as a win, despite the fact this type of announcement has already occurred multiple times for very different reasons since Trump took office for a second time. From investments in the US infrastructure to investment in US company to the plane gifted by Qatar to President Trump and on and on. Now, let's put aside the whole circus about President Trump and let's start talking about serious stuff. First of all, please have a look at the chart in front of you. In the chart, you can actually see what I warned about last week. Because we were entering option expiration week and we had a perfect setup for a volatility shock to trigger, they have expected significant moves in the oil price and a rise in volatility. But at the same time, we would have expected the shorts and the market makers to defend their positions very hard. All of this is exactly in the chart in front of you. It signals out, despite all that happened during the week, day after day, we saw a greater and greater level of escalation in the Middle East, the military conflict between the US and Iran intensifying and spreading more and more beyond the Strait of Hormuz, now involving all GCC countries in the Middle East, including Saudi Arabia, with reported attacks all the way west to the strategic port of Yanbu, where, let's not forget, the very important east to west pipeline ends. A once secondary pipeline that is now critical, allowing some oil exports to shift from the Strait of Hormuz to the Red Sea. Last Sunday evening, 6 p.m. Eastern Time, it was objectively impossible for oil prices not to spike right out of the gate when trading resumed, as I warned about in episode 85. But after the last taco was served to traders on Tuesday by President Trump, then crude oil prices started to go sideways. And while that happened, there was an incredible amount of events and headlines that kept coming one after the other. In a free, rational, and efficient market environment, that storm of headlines would have triggered a significant and understandable volatility spike. However, let's congratulate the government-sponsored crude oil price manipulation. Let's congratulate the effort of the shorts that didn't give up, but only retreated. And lastly, let's congratulate the effort of brokers who had to protect their profits till option expiration on Thursday and succeeded doing so. All this together successfully managed to cap the price right before it broke very important $82 resistance levels, a resistance after which a void opens. If that resistance level breaks next week, the gap between $82 and $84 on WTI can be closed very quickly. But the oil price didn't move particularly freely on Friday after OpEx still. Yes, it ended the day almost 4% higher, finally reflecting some of the news and events of the geopolitical market that then being ignored till then, but it stopped right underneath the critical $82 resistance. To be clear, the price I'm referring to is the WTI futures oil benchmark contract that since Friday shifted from the August to the September contract. It is undeniable how tightly the oil market is being managed, because everyone knows how fragile and disconnected from reality is. Everyone knows that if the manipulators step aside, the oil price will quickly fly to all-time highs, leaving behind a large amount of incredibly reckless speculators who are currently entrenched in an astounding amount of short position that they cannot even cover, because otherwise they will trigger their own short squeeze. While last week there were still people talking about an oil glut, thinking that the US and Iran were still exchanging just some love taps, and things would not have escalated further during the weekend, this week, with traffic in the Strait of Hormuz crashing to the floor, besides some crazy mariners who still tried to cross it under either Iran or US military guidance, no one in commercial shipping wants to put their life at risk anymore just to prove a point, either for Iran or for the US. As of Thursday, as you can see in the chart, only 3 crossings in total were recorded. These make it official that Strait of Hormuz cannot be considered fully open anymore, regardless of whatever anyone wants to claim on the matter. It is now an active and dangerous war zone. It is not going to come back to normal anytime soon. Period. However, oil prices barely reacted to this objective and bad development. Goldman Sachs calculating that there is still over 10 million barrels a day of crude oil supply lost every single day. Commercial inventories across the world continue to go down, even if the EIA in the latest report manufactured an oil build. As you can see in front of you, the EIA started cooking the numbers. As highlighted in my review on Slice Finance Thursday, the EIA effectively borrowed a page from the BLS data manipulation playbook. Now, There is no one around there arguing how fake the inflation data and employment data that the BLS reports every month are. On Wednesday report, the EIA posted a large 10.3 million barrel build in overall used oil inventories. Wow, great. Let's give it another clap. Or 13.3 million barrels if we exclude the SPR draw. Honestly, when I first saw the headline number, it gave me a strong sense of deja vu from the BLS days. Now, notoriously delivering unreliable data. So I started to look under the hood. Commercial inventories minus 1.7 million barrels. Strategic petroleum reserves minus 3 million barrels. Slowdown in the draw that might signal that the SPR is nearing the more and more critical bottom. Otherwise, you wouldn't justify the slowdown when the DOE already leaves out 36.5 million barrels that still have not been taken out. Total gasoline, minus 1 billion barrels. Distillate fuel, plus 4.7 million barrels. Okay, now the funny part. Propane, plus 3 million barrels. And other oils, plus 6.8 million barrels. Other oil, you might wonder, is the inventory of natural gas liquids, kerosene, asphalt, and road oil stored in bulk terminals. In a nutshell, the EIA report's strong build was concentrated in non-critical items. Literally, the last two lines at the very bottom of the report, as highlighted for you. How convenient, right? Furthermore, it is becoming evident that over the past 3 weeks, the EIA made a significant use of adjustments, a statistical trick that has helped inflate commercial crude inventories by 13.5 million barrels, as themselves report. The last noteworthy item in the report was a small increase in Cushing, Oklahoma inventory, which remains stuck at roughly 20 million barrels that are considered tank bottoms. And what's even more hilarious, and I believe it's not a coincidence whatsoever, is that the following day after publishing that extremely fudged report, the EIA posted an article asking a question. What are tank bottoms? Wow. Here is what the EIA itself has to say on the matter. The relatively high WTI Cushing price suggests that recent low inventory levels may be near tank bottom levels, contributing to extreme tightness for Cushing storage operators and the mid-continent crude oil market. Wow, my dear followers, isn't all of this simply incredible? It is definitely incredible. It's the next thing I'm going to show you. Putting all together all that happened this week, the war in the Middle East continues to escalate, with now reports of bridges, water desalination facilities, and even some jet fuel and crude oil storage facilities serving the U.S. military effort being hit by Iran and the U.S. respect. The U.S. is also enforcing a different type of blockade this time around. Not just the standard type of blockade that would have stopped any ship at the very entrance of the Arabian Gulf, but now the U.S. is proactively attacking even empty oil tankers related to Iran, preventing them from entering or loading into Iranian ports, effectively shaping up to what resembles a good old port siege. The reason why the US is doing this is pretty obvious to me. Iran managed to continue its crude oil production and not shut in during the first phase of the war because they had a lot of empty oil tankers they used as floating storage. For the same reason, they managed to quickly take out from the Strait of Hormuz roughly 80 million barrels as soon as it was possible. Now, all those ships are out and the ships remaining inside are actively targeted. This means that the US tactic is to force faster shutting in of Iranian oil production, accelerating the crippling of the most important economic part of the country. Another factor that, on top of everything I said so far, should be very bullish for oil prices. But why are we not yet at least at $120? And here is the reason. Because short sellers and government-sponsored manipulators are being effective in their endeavors. However, now they have to start retreating, allowing for some pressure to leave the pressure cooker. Because, as we said, if a big geopolitical shock happens and volatility spikes, things can go out of control all of a sudden. In order to decrease the chances of a Armageddon in the oil market, I expect that this orderly retreat is going to make the price of oil in the foreseeable future look like stairs, with steps climbing higher and higher. Because they don't want this pressure cooker to explode, they need to start releasing more and more pressure out of it. And there is no alternative but allowing crude oil prices to rise. There is no alternative to the fundamental law of supply and demand. Real crude oil barrels, differently from paper oil, cannot be printed out of thin air to solve the problem. Cannot be any other way. However, this type of behavior is going to make the oil price very difficult to trade in the short term because timing becomes crucial. Every single time the oil price will start to move sideways, technically speaking, everyone will think that the move is over. As it happened this week with additional reports that the situation was normalizing every time the attacks in the Middle East posed. The truth is that when everyone contributing to capping oil prices coordinate by themselves, and as it happened early this week, they decide it's time to release a little bit more pressure, the price will quickly jump higher and then normalize their level. They have to be very careful with this because any potential escalation or volatility trigger can be a disaster and trigger a sharp normalization in crude oil prices. This is the reason why I bet Scott Bessent is surely keeping a close eye on the volatility level of crude oil. As you have seen, after the first jump this week that moved the price higher, it started to move down. President Trump claiming that Iran called him, that they wanted to have a deal, that they wanted to discuss, and then quickly turning around from imposing a 20% fees in the Strait of Hormuz to claiming that they were in full control of the shipping, blah, 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 the usual stuff. In order to understand if this whole apparatus remains in control of the crude oil price or not, you need to keep an eye on volatility. If volatility starts moving sharply on the way up, you know that there has been a significant rise in pressure within the cooker. And if not quickly managed, it might trigger an explosion and a very disorderly repricing of oil to where it should be. If you want to know more about this, I recommend all of you to read my extensive analysis I published on my Slice portal on Friday. The title of the analysis is Welcome to the New Era of State-Controlled Crude Oil Prices. Because this topic is critically important, you can access this analysis and my premium content on Slice for free, thanks to a 7-day free trial promotion that expires next Friday. If you want to access my premium content for free for a week without any immediate charge or future commitment, and then decide whether to stay on board or not with me on Slice, you can find the link in the description of this video. I want to begin the second part of today's podcast with a question. I believe this is a question everyone has in their own mind right now. What happens when you cannot manipulate market prices to hide reality? And the answer, ladies and gentlemen, is in front of you. As you can observe, the price for diesel has started to significantly detach from crude oil prices starting from mid-June, starting from the day of the signature of the completely embarrassing MOU. It was used as a cover to deliver a big dump lower to crude oil prices. The reason why they cannot manipulate diesel or gasoline prices effectively is very simple. There is no significant futures paper market on those products whatsoever. The option market is practically non-existent, with very less than 1,000 options traded every day. The number of futures contract volumes is minimal as well compared to crude oil. As a result, it's very hard to hide what's happening in reality under a mountain of financial paper. A reality where, as you can see in the next chart, crack spreads continue to hit newer and newer time highs. The 3-to-1 crack spreads closed the week at $69.55 despite an 11% rise in crude oil prices. This means that, as we know, there are worse and worse shortages in both crude oil and refined product. This combination can be extremely damaging for the real world economy. These shortages are intensifying in the worst possible moment. The moment when everyone around the northern hemisphere needs to start restocking fuel ahead of winter. Restocking is going to be particularly intense this year, considering their normally very low level of commercial inventories we are currently at. Before moving to the last part of today's podcast, if you like my content, don't forget to like the video, subscribe to the channel, and turn on the notifications if you don't want to miss any of my future updates. Here, I want to conclude the last part of today's podcast with a very important update: the Korean stock markets, especially the Kospi index. I flagged 10 days ago how the Korean market was trading in a return to normal stage of a bubble. Fast forward 10 days, because of what happened this week and the big break of the last important support level, we are now officially in the fear stage. This is when things start to become nasty. There cannot be any better proof of what's coming next and what is going to be brutal for our investors than what happened on Thursday, when there has been literally a South Korea stock market deleverage storm with 1.2 million accounts that faced margin calls and had to post cash as soon as possible, with 360,000 retail investors completely wiped out. As I warned many times, this was a disaster just waiting to happen. While everyone was cheerleading the meteoric rise of SK Hynix and Samsung beyond the stratosphere, I was warning and showing in this chart in front of you how all that bull run was simply built upon leverage and derivatives. Because of the incredible demand of Kospi, options, and derivatives, driven by investors' irrational exuberance and fear of missing out, the whole bull run occurred. At the same time, when the VIX of Korean stocks broke above 96, I believe no one dared to flag this risk but me. Everyone was too busy popping champagne bottles. The Korean government was praising a new economic era and doing nothing to warn people or to curb speculation, till it was very late. And now it's definitely very late. Thanks a lot for listening to my podcast again today, for supporting me on X, for reading my research on justdario.com, and for subscribing to my premium content on Slice Finance. I wish everyone a nice Sunday. Bye.